This is Behind the Headlines, with behind-the-scenes analysis on issues affecting Pennsylvanians, sponsored by the Susquehanna Valley Center for Public Policy. Now, here's your host.
Hi, welcome to a new edition of Behind the Headlines. I'm Charlie Greenawalt, Senior Fellow of the Susquehanna Valley Center for Public Policy, and I'm joined, as normal, by my co-host, Mara Donnelly. Hi, Mara.
Hello, Charlie.
How are you?
I'm doing well, thank you.
2014 marches on.
It is.
And we find that the whole issue of voter ID won't go away, will it?
No, not anytime soon.
No.
Or maybe it is going away. It's hard to say.
It'll be interesting to see what happens as the courts continue to look at that. Of course, one of the things that's moving closer and closer to us is IRS Day, Tax Day, our day to file our federal taxes. And, of course, we have looked at financial issues over the last several years with the Arnold Report. And we'd like to do a little closer examination today by having one of the top financial planners and one of the top authors on finances in Pennsylvania be with us today. We're fortunate enough to have Rick Rodgers with us. Rick, welcome to the show.
Thanks for having me.
Rick, you are the founder and the president of Rodgers Associates, and you are the author of the new Three-Legged Stool, this particular book. How did, I guess let's get started by just asking, how did you get into financial planning, and how did you have time as a financial planner to write a book?
Well, I was always very interested in money as even a young boy, and so I thought about, well, what could I do that would involve money? And the idea of banking, of course, came up right away. That sounded a little bit boring. The idea of investments sounded much more exciting, and so I pursued a career in financial planning, working with investments, starting out with the big Wall Street firms in the mid-1980s, and then starting my own firm in 1996. And so we're beginning now our 18th year as a financial planning firm.
Congratulations.
Thank you.
Now, can you tell us a little bit, we probably spend time throughout this show on talking about the new three-legged stool, but was there an old three-legged stool?
There was an old three-legged stool, and I think that's how the discussion should begin.
Okay.
Because the original three-legged stool, as it pertains to retirement planning, came about in the 1970s. And back in 1974, we had two major pieces of legislation that were passed. And the first one was the Employment Retirement Income Security Act, ERISA, which standardized pension plans. So pensions became a much more higher profile part of retirement. At the same time, Social Security, which had been around for many years at that point, got a cost of living increase automatically tagged onto it. So Social Security also became an important part of retirement. So the original three-legged stool was Social Security, pension, and your personal savings. And retirement planners at that time thought that in order to have a solid retirement, you needed those three legs. Well, today, pensions are on the way out. At least on the private side, they're on the way out, and probably on the public sector is going to be severely curtailed. Social Security as a leg is wobbly at best, and so now we need a new three-legged stool, which is tax-deferred savings, your 401k and IRA, tax-free savings, which would be your Roth IRA, and your after-tax savings, which would be your investment accounts.
Wow, that's a big shift.
That is a big shift.
Yeah.
And what makes it particularly important today is because for the last 25 years, all of us have been told that all we have to do for retirement is to defer because you're going to be in a lower tax bracket when you retire. And that probably had been true for the last 25 years. But today, if you're going to be in a lower tax bracket, you're going to have to plan for it. And that's what the new three-legged stool is all about. Planning for a tax-efficient retirement, because tax rates are probably going up, and they're probably going to affect retirees more significantly than what they have in the last 25 years.
Well, when we think of financial planning, and we tend to think of, frequently tend to think of the stock market, and you find that the stock market was up over 30% last year.
Right.
It's up more than 170% since the low in 2009. Should investors be buying or selling stocks right now?
Well, that's an excellent question, but it is a timing question, and unfortunately, it is the wrong way for investors to be thinking about stocks. We need to have stocks in our portfolio, and we need to have probably a significant portion of our portfolio in stocks. But the problem that people have being successful at investing is they think, in order to be successful, I need to be in stocks when they're going up, I need to be out of stocks when they're going down. And that is a loser's pursuit. People are buying at the wrong time, selling at the wrong time, and inevitably what they try to do, or what they end up doing, is buying high and selling low, which if we all sit here and think about it, we know that that's a way to lose money in the market. What we should be doing is to create a strategy that's going to reach our goals with the least amount of risk, which would strategy should employ some portion of stocks, and let's just say for the sake of this discussion, it's 50-50. Half of our money is in stocks and half of our money is in lower risk investments like bonds. As the market is rising, if we're going to be out of balance. So after a 30% year in the market like 2013, we're overweighted in stocks. What people should be doing today is rebalancing. Getting back to your 50-50, which allows us to harvest some of those gains since the market went up. If the market does go down in 2014, and I don't know that it is, and neither does anybody else that is just guessing, and they could be right or they could be wrong, but if the market does go down, now you'll be overweighted in your fixed income, and you'll use that opportunity to rebalance, which means you'll be buying stocks while they're down. And buying low and selling high is a successful investment strategy. Mm-hmm. And that's what people should be doing right now, not trying to guess whether the market's going to be up or down, but rebalancing, staying with their strategy. Sometimes we're going to be really happy we have money in stocks, and other times we're not going to. Yeah, sometimes we're not. But in the long run, and this is what I would like your viewers to take away from this, in the long run, stocks go up because they're businesses. It's not gold, it's not silver, it's not something that's subject to some kind of whim of supply and demand, because in 2008, when the economy spiraled downwards, what did businesses do? Well, they laid off people, which made unemployment go up, and so that's kind of bad for people that got laid off. But they did what they needed to do in order to remain profitable. And as they remained profitable, they survived, and not all of them survived, but most of them survived. And those that have come out of it now are in much stronger position than what they ever have been. And so stocks go up because people are creative, they come up with new ways of making money, they come up with new markets, and stock prices are continually on an uptrend with temporary dips.
People have been a little bit, we're coming off a really rough couple of years in terms of the stock market, and people are working much longer than, or way past 65 years old, because they feel like they really need to be making the income. Why do you think so many people are coming up short on retirement? Does it have to do with the fact that they haven't been balanced and aren't prepared?
Well, that's kind of a complicated answer to that. And I think a couple of the major things is that this generation, and I'm saying the baby boomers that are retiring now and thinking about retiring, it's the first time for as long as retirement has actually been a modern phenomenon, that people have not had pensions and Social Security to rely on. And we are also kind of benefiting from advances in medical technology that is allowing us to live longer. Wow. So back when the original three-legged stool was in place in the mid-70s, people were only expected to live 5-6 years in retirement. Well, you don't need a whole lot of money to last 5 or 6 years. But a healthy 65-year-old couple has a very good chance of living 30 years in retirement. At least one of them is going to live 30 years. And to live in retirement for 30 years takes a lot of money. So a couple things have happened. One is their parents relied on pensions and Social Securities, and they can't do that today. Secondly, we've got a lot longer to plan, and in order to accumulate that amount of wealth, we needed to start when we were 20 or 30, and a lot of people procrastinate. And so when people ask me what the biggest mistake with retirement is, that people make, it's probably procrastination. You wait too long, you save too little, and it's tough to play catch-up when you're 50. But when you're 20, $100 a month goes a long way. Mm-hmm. Starting at 20, $100 a month without ever increasing it is $1 million by the time you're 65. But if you wait until you're 30, now you've got to save $300 a month. And every 10 years that you wait, you've got to triple the amount that you're saving to get to the same place. So start early, save often.
Mm-hmm. Rick, one of the things that we have heard a lot about, at least since the election, since the midway through the first term of President Obama, is this whole policy of quantitative easing. Mm-hmm. Can you tell us what quantitative easing
Please.
is? I think Maura and I have a good idea of what it is. We've talked about it before, but could you tell our viewers again what quantitative easing is, how it affects the stock market, and if you think, what do you think the Federal Reserve is going, because they're the ones that determine whether or not we're going to have quantitative easing or not. What is their policy going to be, and what's the outlook for the stock market?
Well, your viewers have probably heard the term QE3, which is quantitative easing 3. It's the third round of quantitative easing. And what the Federal Reserve is doing is buying, or had been buying, $85 billion worth of bonds every month. So these are corporate bonds, these are mortgage bonds, probably mostly mortgage bonds that they're buying. And what that does is it creates cash in the system, because they don't actually, the Federal Reserve doesn't have to have the money, they just credit the banks with the money. So your viewers may have heard of it referred to as printing money, because they're just creating money by buying these bonds. And they've been doing it at the rate of $85 billion a year, or excuse me, $85 billion per month, to put liquidity into the economy in hopes that people would borrow money, that businesses would borrow money, and it would get our economy moving again. And back in May, then Federal Reserve Chairman Ben Bernanke said that he thought that at this point they would probably at some time, maybe in the near future, kind of cut back a little bit, and he used the word taper. He said we were going to taper. And that sent the stock market into a downward spiral. People started worrying that now that they were going to taper, whatever that meant at that point, that was going to make interest rates spike and the economy was going to immediately go back into a recession. Well, that didn't happen. And in fact, they didn't start to taper until December when they cut back to $75 billion per month. And that seems to be at the pace. And we now have a new Federal Reserve Chairman, Janet Yellen. And Janet Yellen has written quite a few times and in her speeches has talked about her view of the Federal Reserve as being one of promoting full employment. And so I believe that as chairman of the Federal Reserve, whatever changes to quantitative easing are going to be slow in coming and will follow this trail of taper. So I don't believe that the Federal Reserve's policy of quantitative easing is going to have a major impact on the market this year, because it's probably not going to change very much this year.
Okay, in our last 30 seconds, we're going to talk a little bit about mistakes people make, but let's give people let's end on a high note. What's the best thing somebody can do right now for their retirement plan?
Part of your retirement planning is accumulating enough money to be able to retire, but it's also another important part, and I would say probably even more important, is how much are you going to spend? And I would suggest that everybody who's thinking about retirement a year, 2 years out, would take a hard look at their spending, because first of all, we want to know that we can control it. Because if you can control your spending, you're never going to have problems with finances. Or I shouldn't say never, but rarely are you going to have trouble, because once you learn how to control your spending, and that sounds so simple, yet very few people know how to do that. So get a budget, get your spending under control, and make your future in 2014 from a financial standpoint look a lot brighter.
This time went by way too fast, Rick.
I'm not done yet.
Maura and I have to have you back very soon, particularly as tax day approaches. So we'll be in touch, and we hope to see you back here very soon. Thank you again for being with us. We'll be back with segment 2 of Behind the Headlines right after this.
Behind the Headlines is brought to you as a public service by the Pennsylvania Business Council, envisioning a commonwealth in which residents enjoy a very high quality of life in sustainable communities. The Council works aggressively to define key long-term policy strategies and solutions to make the Commonwealth more competitive, creating and sustaining a better Pennsylvania. Additional underwriting provided by the Worrell Corporation Foundation, based in Carlisle, Pennsylvania, by the Edward H. and Jeannie Arnold Foundation, and by the Pennsylvania Manufacturers Association. Business in Pennsylvania is our business. Behind the Headlines is also supported as a public service by Daily Express, transporting construction, farm, and industrial equipment throughout the United States, and by the Pennsylvania Highway Information Association, the go-to source to learn about transportation projects and issues. Visit pahighwayinfo.org. And by Penn Waste, your best local choice for your waste removal and recycling needs.
Hi, welcome to the second segment of Behind the Headlines. In this particular segment, I will be joined by Susquehanna Valley Centers for Public Policy's chairman and one of the deans of the business world and one of the leading businessmen for many decades in Pennsylvania, Ed Arnold. Ed, welcome back to the show.
Good to see you, Charlie.
It's nice to have you here. We were talking with Rick Rodgers about many items related to personal finance, and we wanted to have a normal Arnold report here because we have questions from you, the viewing audience. And again, we urge any of you that have questions regarding finances or the state or national economy to please send them into the email at the bottom of the screen, and we'll submit them to Mr. Arnold. Let's start out with the first question that we have here, Ed. Number one, should our state be buying gold and stockpiling it as some of the other states are, or that some other states are and some governments are around the world?
The answer is no. Very simply, why? Because gold is really a currency. Only 25% of gold is used for primarily jewelry and some electronics. It is basically a store of value, and therefore it is a substitute for our currencies, which are no longer much of a store of value. So the answer is our state should run their pensions and their whole challenges they have in their budget. Don't worry about trying to speculate in a currency.
So you think the states that are stockpiling gold are wrong?
Yeah, yes, I do.
Okay.
I do.
Secondly, what is a triple tax-free municipal bond? One of our viewers wants to know.
Well, basically, you've got three taxing organizations: the federal government, the state government, and the city government. The only city government that actually would tax all income would be the city of New York, to my knowledge. Whether there's any others, but nothing in Pennsylvania. So the answer is, in Pennsylvania, you'd normally probably a double tax-free, not a triple, because cities would not be taxing.
Okay. A third question that's come in from our viewers is, what is a BRIC nation, a B-R-I-C nation, and why is this acronym important in investing?
Well, basically, it is a reasonably recent term, but it's the new emerging market. Brazil, Russia, India, and China. Just for your information, Brazil is about 200 million today. Russia is about 145 million. India is 1.2 billion. China is 1.4 billion approximately. It says the U.S. is 320 million, and Indonesia is 250 million. Those are the largest countries. So really, these are primarily the largest economies in the world, and they are relatively dynamically growing economies.
Mm-hmm. Yeah, and you find that Brazil is a source of natural resources, as is Russia. India is big in computers, and China is big in manufacturing, I guess.
That's correct. India is basically software.
Mm-hmm. Number four, how does one determine the true liquidity of an investment? And I guess before we answer that, you should just be sure to define liquidity again for our viewers.
Well, liquidity basically is your ability to turn an investment into cash. That's very simple, really.
Sure.
And so obviously, if you have a stock, you put it to call your broker, you say, I want to sell it. Within 4 days, generally speaking, 4 business days, you can have cash. So it's very liquid. If you're dealing in a stock that is traded on a very regular basis, so that your bid and your ask, the bid and the ask is for everything. Everything's an auction. You say, I want to sell 100 shares. Somebody else says, I'll buy the 100 shares. There's a bid and an ask. So the more active, the larger the company, that spread is very small. In a small company, it could be quite large. But therefore, they're still going to generally trade in that same day. It's possible they wouldn't. Bonds tend to be less liquid. But again, if you buy specifically a bond fund, therefore, again, you can sell it, and in 4 days you can have your cash. So that's what you really do. The other side of that coin, if you were dealing in commodities, again, if you deal in funds, whether it's GLD, which would be a gold fund, again, they're a very large fund. There's a bid and the ask. It can be transferred. You can get your money, very liquid, in 4 days. The exact opposite, just to show the exact, is private investments. You say, well, gee, this is a really good little small company, or that is extremely high risk. Liquidity lowers risk because you can get your money quickly. When something is frozen, you can't get your money. So therefore, there's a risk. It may deteriorate while you're waiting to get your money. If you are in a private investment, it either has to go public, be purchased by a third party, or liquidate. Those things generally take many years. So anytime you would get into alternative investment of that kind, private, you should really check when is there going to be a liquidity event. Okay.
Okay.
Pretty much
Our fifth viewer and question from our viewing public is how can I go about investing in foreign currency? Is it a good idea to invest in foreign currency? How do I go about doing that? How do I invest in foreign exchange markets?
Well, relatively speaking, again, we're back to a risk type thing. In a foreign market, you would probably want to use an ETF. There are ETFs in currencies.
ETF stands for what?
Exchange Traded Fund.
Okay.
And because I don't think any of us are quite wise enough to say this is the currency I want, a fund would probably invest in a multitude of currencies. Right now, I would consider it be a very good part of your portfolio to diversify, because the dollar, you are in sense, if you invest in stocks in America, you're investing in the dollar. Mm-hmm. The dollar is a very weak currency today because we're printing so much money. So therefore, relatively speaking, that it depends on right now, as an example, what has happened in currencies. Brazil, because they've had tremendous turnover, their currency actually has fallen in relation to the dollar, and so has India. So again, at one time I'd have said, gee, India is a great place because it's a growing big country, but their currency, because of their questionable government, that their currency isn't strong. So it would be better to be in currencies possibly, but the other alternative to that would be to buy stocks in foreign markets. Mm-hmm. Again, you would probably use an ETF or a regular mutual fund, which again would give you a variety of stocks, not necessarily in one country, but in like an Asian fund. They would invest in all the countries. Some funds are Asia without Japan. Sometimes are Asia without China, because these are such giant countries. But basically, back to which we'll talk about later, is picking an advisor. You need somebody to help you in this area. But yes, it would be good diversity. I mean, right now, as an example, recently, Europe is now starting to come back to life, their stock market, which has suffered, and it'll probably do better than the American market now because it's been so down. This is the same way that the euro so far last year, had done very good against the dollar. It's recovering. So again, to say that your sophistication as an investor probably isn't there, to diversify into a multitude of currencies, a multitude of countries and stocks, foreign, but that would be diversifying away from America, which is a good idea because you don't want to have all your eggs in one basket, and America is a basket.
Mm-hmm. Well, as we saw with Rick Rodgers, and as you just referenced, one of the major things that we have to be concerned about when we're looking at personal finances is how do we go about finding the best financial planner, the best financial advisor. What do you think?
Well, first of all, we got to look at there's sort of two skill sets here, and they can be combined. And that is a financial planner really tries to show you what, with your situation, here you got so much coming in with Social Security, you have this kind of a pension plan, you have this many dollars, how should you, and this is your spending pattern, this is what you need. As he said, you've got to control your spending, but you've got to balance. This is what my income is going to be, this is what my spending is going to be, and they got to be balanced. You also have to realize that you have inflation. That basically 10 years from now, what you buy today for $1 is going to cost $1.40 probably. Or something along that line. It's going to, and this has happened. I mean, if you were to go back to the Nixon era, the dollar has dropped over 80% since that time. So your purchasing power, and most pension plans, you get a fixed amount of money each year. It doesn't go up. Social Security is pegged to inflation, so that will continue to rise. But your investments, can they keep up with inflation? So therefore, you have a financial planner of what's my plan. Then you have an investment advisor. Now, many people, you would put that together and call it a financial advisor. That is a person who would do both the help in your plan, but also would help you in your investments. He'd be probably a company. Some of the things you would look for is a certified financial planner. This is just like sort of like a CPA, or a chartered financial consultant. These are the two acronyms that would tend to be used. And for that matter, if he works for a company, is the company a registered investment advisor? These are all organizations that are certified by the government that basically have educational qualifications, and have financial responsibility. So it's very important that you make sure that the person is qualified, but then you get back to really, what do they charge?
Well, should I have choices? Should the investor have choices on how to pay the financial advisor?
Well, I think a lot of financial advisors say, this is my structure, so this may force you into change. Some may be very heavily fixed, but most would be a combination of fixed charge, flat rate for what you do, and or maybe so much an hour, and commission. The commission can be very dangerous because obviously if they have two products they want you to buy, the one product they get a 7% commission, the other get a 3%, they're going to tend to be, you got to be careful and be biased to put you in the 7. So basically you understand, how do they get remunerated? What are the hidden charges, if there are any, of your investment, and how much that comes back to your advisor? Because so therefore there's a lot of different areas to look at. Normally you're going to say, do I feel comfortable? Do I trust a person? Do I believe in the person? But you've also got to check, what has his past track record been? Overall, what is his expertise in advising you to invest in foreign investments or to invest in currencies? Does he have somebody on his team, or does he have somebody he refers to that, and what is their track record? So you're back to, again, a variety of things, like one of the areas which they might try to sell you. And I'm not saying it's wrong. It depends what you need. It's a very personalized thing. I could say, for me, I think you should do X, Y, Z. I have not talked about here any kind of specific investments. That's what you have a planner, that's what you have an advisor, because he should customize it to what you want to spend, how you want to live, what your resources are. And I think you've got to put all those together before you can say, gee, this is what I should do, such as buying an annuity, which would be, that's a very big decision. You need advice for that.
In the last 30 seconds, we find that some situations we have investors that have financial planners and they change firms. What are the consequences for the investor when that happens? What are the consequences for the advisor?
Well, generally speaking, if you have really a strong advisor and you have faith in him, he will in fact continue to find you the best resources. And I would say you're dealing with the individual advisor, and you would have faith in his confidence of what he's doing. So that, but the one thing I just want to, last thing is, remember, inflation is a major item in planning. Since the last 100 years, the dollar has dropped 95% in value. So when you say what you're going to need today and what you're going to need 20 years from now, and when you retire, you're probably going to live more than 20 years. You've got to look at your whole structure of your investments are going to be, you're going to be able to buy less and less with your dollars. You're going to need more dollars.
Okay. Thank you very much, Ed, for being with us. I think that was a good coda. It's a good follow-up to Rick Rodgers' advice.
Yeah, I think it worked out very well. It really
thank
was
you very
perfect.
much for being with us.
It was very good.
We'll be back next week with a new edition of Behind the Headlines. Be here. We'll see you then.